Holistic Plan presents Tax Time with Jeff Levine. Let's talk taxes.
Hey everyone, Jeff Levine here, and it is awesome to be with you once again. Today I thought we'd spend some time talking about equity compensation. See a lot of questions about equity compensation and how it works and how do you model this in tax software, and that requires at least a basic understanding of some of the tax properties of different types of equity compensation. And we could spend the next 2, 3, 4 hours, maybe next 2, 3, 4 days talking about equity compensation and planning around them and the rules. But today I wanted to give a high-level overview of 3 types of equity compensation. And we'll begin with non-qualified stock options. Now, the term non-qualified as the beginning of that sort of equity compensation should give you a hint that these aren't going to get much of a tax break. And in fact, they don't. Non-qualified stock options, while being the most common form of equity compensation or most common form of a stock option granted, are not entitled to any special tax benefits. So when an individual exercises them, and exercises a non-qualified stock option, they're subject to ordinary income on the spread. The spread there being the strike price of that option, or the price that they're buying the stock for, if you will, and the true price of the stock. So if my non-qualified stock option says I can buy this at $10, but the true price of the stock is worth $18 at the time I exercise, well, there's an $8 difference, right, between the price that I'm paying for it and the real price of that stock at that time. That amount is going to be ordinary income, and it's going to be taxable to me on my W-2. It'll be reported on a W-2 along with the rest of my income, and I will have ordinary income tax on that amount. Now, once I own the stock, it's just like any other regular stock investment. So if I hold it less than a year, well, then I'm going to have short-term capital gains. If I hold it for a year, more than a year, then I'm going to have a long-term capital gain. So there's not much in the way, really not any benefit from a tax perspective to non-qualified stock options. So a common question I get is, well, Jeff, what's the benefit? Why do they even issue non-qualified stock options? The benefit is that you're buying the stock cheaper than you could buy it on the open market, right? In my example, I said you're buying it at 10, but it's worth 18, and the difference is taxable. Well, it's taxable, but you're also getting that $8 value essentially for free, because if you went out and bought the stock on the open market or had to pay fair market price, you'd be paying $18. So it's still better. It's just not better from a tax perspective, right? It's just better from a total equity or total cost perspective. The next type of equity compensation I want to discuss today is incentive stock options, or ISOs is a common way to hear that. And incentive stock options are a type of option that do in fact come with substantial tax benefits, at least if you follow certain rules. Specifically, you have to hold those options at least 2 years from the grant date and 1 year from exercise. Again, that's 2 years from the grant date and 1 year from exercise. You have to hold those equities in order to receive long-term capital gains on the difference between the price, the exercise price, or the price that the strike price, the price that you bought the security at, and its actual fair value when you made that exercise. So in our example before, we said it was worth 18, but you bought it for 10. Well, if that was an incentive stock option and you met the grant holding period of 2+ years, and you met the holding period of the actual stock after it was exercised of more than a year, well, in that case, you're entitled to long-term capital gains treatment. You're entitled to long-term capital gains treatment, not only on the growth after exercise, but also on that $8 difference in the price initially. So that's a pretty powerful tax benefit there as well. And on top of that, incentive stock options, they're not subject to Social Security or Medicare tax or even withholdings on a W-2. So there are a number of benefits on ISOs, even beyond just the regular, quote-unquote, savings on taxes between ordinary income tax rates and long-term capital gains rates. The final piece of equity compensation I wanted to discuss with you today is restricted stock units and awards. And this is just simply a way for employers to grant company shares to employees. The restricted part essentially just means you've got to stick around for a period of time. Like, hey, we want to make you feel like you're part of the company and invested in the success. We're going to give you some of these shares, but we're not just going to give them to you and let you quit the next day and sell them back to us or sell them to someone else. We want to make sure you stick around for a while. So we're going to subject them to a vesting schedule. Now, that could be a vesting schedule that says if you stick around for X period of time, they're all yours. It could be that each year you get a certain percentage vested, depends upon the particular company. But from a tax perspective, the key here is that when they vest, they are W-2 income and they are ordinary income. So just like non-qualified stock options don't really get a tax benefit, neither here does equity compensation restricted stock. Once again, people ask, well, what's the benefit if there's no tax break? The benefit is you're getting equity for free, right? Like, that's the benefit. Like, hey, here's equity. All you're doing is paying the tax on it, but you're getting the full amount for free. So if you, let's say you got $10 worth of stock and you're in a 20% tax rate, well, it cost you $2 of taxes to get $10 of stock. I don't know about you, but I'll take that break. I'll take that tax deal every day and twice on Sunday. But of course, because these are so nuanced and the differences here, it can make planning for them a challenge. And indeed, one of the best ways to help clients understand the ultimate tax liability is by helping with a tax software, looking at something like a Holistiplan tax planning engine to give your clients an idea of what their tax liability is going to look like, either at the time of exercise or at the time of vesting, etc. And so with that, I want to turn it over to my good friend Ben Birkin, who is going to share with you a little bit about how Holistiplan can help advisors identify the tax impact of various equity compensation so that they can help their clients minimize their long-term tax bite. Ben?
Thank you, Jeff. This is Ben Birkin, Vice President for Customer Success and Engagement at Holistiplan. I'm going to show everybody a little bit how the Holistiplan system allows people to model some of the things that Jeff was talking about related to equity compensation, so stock options and restricted stock options. I've already got a scenario analysis pre-built here into Holistiplan. I've already got the 2020 return in my first column. I've got my baseline set up here in my second column. And then in my third column, I've got a hypothetical, what if we exercised some options? So like Jeff was saying, for non-qualified stock options and effectively RSUs, the way that Holistiplan is going to allow you to model that is going to be similar. To do that, I might go into the wage box. So I'm going to start here with my baseline scenario and see that I've got $200,000 of wage income for taxpayer one, $40,000 for taxpayer two. In my hypothetical, where I'm saying we're going to exercise some options, if I click open my dialog box, now I see that my total wages are higher. My taxpayer two is still going to be $40,000, but I've got taxpayer one now at $260,000. This little yellow triangle is my clue that there's a note in there. When I click that open, I can see that I've already typed in, I've got my base wages of $200,000 and $60,000 of a non-qualified stock option exercise. And I can scroll down to the bottom and see that by exercising $60,000 of non-qualified stock options, I'm going to have, as we would expect, higher total income, higher adjusted gross income, higher tax bill, but I'm still in the 24% bracket. And what's interesting is that I could use the range calc feature to say, hey, I've actually got more room within this bracket before I have to start worrying about a higher tax rate. So maybe if I wanted to, and my clients were amenable to it, I might exercise more options, and maybe up to the point where I jump from the 24% bracket up to the 32% bracket. Now, effectively, you do the same thing for modeling restricted stock options or restricted stock units, because there's no difference in how those are taxed. You have more control over one than the other in terms of timing, right? So if you know you're going to have RSUs that are going to vest in a particular year, you would model it the same way by putting it into the wage income. Now, Jeff was also saying that incentive stock options are a little bit different, that the exercise of incentive stock options isn't going to trigger anything from a tax point of view, which is true, but it is going to trigger something as it relates to alternative minimum tax, right? So the difference between the strike price and the grant price, or I'm sorry, the strike price and the stock price, that is going to show up as a preference item for alternative minimum tax. Don't worry though, we've got you covered. If you expand the alternative minimum tax section, you can see that we've got the line here, row 2I for incentive stock options. So if instead that $60,000 spread was from a incentive stock option, we'd enter that $60,000 here and still be able to calculate any sort of alternative minimum tax bill. I don't think we're going to see one here, but that's how you would do it. Just in case you forget, we've got the scenario recipe in here where we've got one built in for equity compensation, talking about the different types of non-wage compensation, RSUs, NQSOs, and ISOs, how they're taxed, and how you might go about entering them. Hope you've enjoyed this and the other videos we've had in this series. We really want you to make use of HolistaPlan to be a tax planning hero for your clients, and we'll see you next time.